For a decade, a solitary figure held sway over an astounding 5% of the world's vital copper supply, his monumental influence a clandestine operation. The name Yasuo Hamanaka remained utterly unknown to the powerful elites who unknowingly danced to his tune. No corporate titan heading a mining conglomerate, no high-ranking government official, no celebrated financial guru. Instead, he was a mid-level trader at Sumitomo Corporation, a man whose quiet demeanor belied the immense, hidden empire he meticulously constructed. When his meticulously built edifice finally crumbled in 1996, the reverberations were cataclysmic. It wasn't merely a corporate misstep. It triggered the largest single trading loss in the annals of corporate history, unleashing shockwaves that rippled violently through global commodity markets. Hamanaka's unauthorized positions culminated in a staggering $2.6 billion in losses, a sum so vast it could have purchased every share of several major corporations with change still to spare. While world leaders convened to debate copper prices and mining executives painstakingly calibrated production targets based on what they perceived as market signals, Hamanaka was the market. Single-handedly, he orchestrated price fluctuations, fabricating an artificial scarcity for a metal indispensable to modern civilization, from the intricate wiring in our walls to the very plumbing systems beneath our feet. To understand the sheer power Hamanaka wielded, one must visualize the market as a burning room where he held the only exit key. By orchestrating a market squeeze, he ensured that when prices spiked, short sellers, traders who bet prices would fall, were legally obligated to buy copper to close their positions. But since Hamanaka controlled nearly the entire available supply, they had no choice but to buy from him at whatever astronomical price he demanded. He wasn't just predicting the weather. He had built a machine that manufactured the storm. For 10 long years, the global economy, in its oblivious complexity, unknowingly swayed to the secret rhythm of one Japanese trader's audacious manipulations. This is the saga of Mr. Copper, the man who proved that even in the labyrinthine shadows of international finance, a lone individual could exert dominion over commodities essential to nations until the day his concealed empire ultimately fractured, laying bare the terrifying extent of his clandestine power. When Yasuo Hamanaka first embarked on his professional journey with Sumitomo Corporation in 1970, copper trading occupied a relatively quiet, almost provincial corner of the vast international commodities markets. Unlike the more glamorous and publicly scrutinized arenas of oil or gold, copper rarely seized headlines or captured the public imagination. Yet, its understated importance was undeniable. Every electrical conductor, every water conduit, every intricate circuit board relied fundamentally on copper, solidifying its position as one of the most economically critical metals across the globe. Despite this indispensable role, the copper markets operated largely in obscurity, a niche domain dominated by a tight-knit community of highly specialized traders, formidable mining companies, and industrial giants who profoundly understood the metal's crucial role in global manufacturing. Sumitomo Corporation, a venerable institution founded in 1919, had forged its sterling reputation largely through its prowess in metals trading, with copper as its undisputed cornerstone. The company's roots in the copper trade actually reached back over 400 years to the 17th century Edo period, when the founding family perfected the Nanban-buki copper refining technique and opened the legendary Beshi copper mine in 1691. While the trading corporation itself was formally established in 1919, its dominion over copper was a centuries-old heritage. By the 1970s, Sumitomo had blossomed into one of Japan's preeminent Sogo-shosha, major trading houses, boasting sprawling operations that spanned a multitude of commodities and diverse geographic markets. Within this expansive corporate structure, the copper division commanded a particularly prestigious position, entrusted with orchestrating trades valued at hundreds of millions of dollars annually. It was into this storied legacy of tradition and immense corporate weight that a young, unassuming graduate stepped in 1970. Hamanaka's nascent career offered scant presage of the colossal empire he was destined to erect. Born in 1950, he joined Sumitomo in 1970 immediately after graduating from Seikei University with a degree in law, an unconventional academic background for a man who would soon orchestrate the most complex financial manipulation in history. His colleagues, recalling those early years, described him as a man of quiet disposition, exceptionally methodical, and endowed with an intense, almost obsessive focus on dissecting market dynamics. He devoted years to meticulously absorbing the intricate technical aspects of copper trading, the ebb and flow of supply and demand fundamentals, the subtle nuances of seasonal patterns, the cyclical nature of industrial usage, and the complex, interdependent relationships between mining production and manufacturing demand. He was a sponge, soaking up every morsel of market intelligence. The copper market that Hamanaka entered in the early 1970s was a hybrid entity, functioning through a sophisticated interplay of physical trading and an increasingly complex array of financial instruments. Its beating heart was the London Metal Exchange, LME. Established in 1877, the LME had evolved into the world's undisputed premier venue for metals trading, where prices were determined through a distinctive blend of boisterous open outcry trading sessions and more hushed private negotiations. Copper contracts traded on the LME encompassed both immediate physical delivery and future supply commitments, creating a fertile ground for astute traders to capitalize on price discrepancies across various time horizons and geographical locations. What lent copper trading its particular complexity was the metal's inherent dual nature. It was both a tangible industrial commodity and a dynamic financial instrument. Unlike purely financial products such as stocks or bonds, navigating the copper market demanded an intimate understanding of physical supply chains, the often overlooked costs of storage, the intricate logistics of transportation, and the constantly shifting patterns of manufacturing demand. Successful traders in this demanding arena required a multidisciplinary expertise encompassing metallurgy, industrial economics, global shipping logistics, and currency relationships, a formidable suite of skills that often took years, if not decades, to painstakingly develop and truly master. During his initial decade at Sumitomo, Hamanaka gradually cultivated a formidable reputation, one built upon an exceptional depth of market knowledge and a keen, almost prescient, trading acumen. He possessed an innate grasp of copper's symbiotic relationship with economic cycles, instinctively recognizing how construction booms, ambitious infrastructure projects, and the relentless expansion of manufacturing industries directly influenced demand patterns. He delved deep into global mining operations, scrutinizing how geological factors, intractable labor disputes, and the unpredictable winds of political instability could disrupt supply lines. But most critically, he began to forge a sophisticated understanding of market psychology, a nuanced insight that would later serve as the bedrock for his audacious manipulation schemes. The transformative shifts sweeping through global financial markets in the 1980s heralded an era of unprecedented opportunities for ambitious commodities traders. Deregulation, the accelerating march of computerization, and the explosive growth of derivative instruments dramatically expanded both the scope and the inherent complexity of trading operations. Markets that had once functioned primarily through personal relationships and a flurry of phone calls rapidly morphed into sophisticated electronic networks, capable of processing vast volumes of transactions with dizzying speed. These epochal changes not only unlocked novel avenues for profit, but also inadvertently created fresh opportunities for manipulation, exploiting vulnerabilities that traditional oversight mechanisms were simply not designed to detect. Following the abrupt departure of his superior in 1986, the quiet, methodical Hamanaka officially ascended to the pinnacle of Sumitomo's copper division, emerging as its undisputed chief copper trader. Inheriting both the title and the terrifying secret debt, he was now solely responsible for managing the corporation's most critical commodity relationships, in a position of immense trust and absolute, unchecked leverage. His remarkable success during the notoriously volatile markets of the late 1980s had cemented his authority, earning him considerable autonomy within the company. This freedom allowed him to execute trades worth hundreds of millions of dollars with minimal oversight, a privilege he would exploit to its fullest. This newfound latitude, coupled with his already profound market knowledge and a rapidly intensifying appetite for risk, meticulously set the stage for the empire-building phase that would define the next trajectory of his extraordinary career. The global economic landscape of the early 1990s provided an almost perfectly fertile ground for Hamanaka's elaborate schemes. Rapid industrialization across Asia, burgeoning infrastructure development in nascent emerging markets, and continuous technological advancements that steadily increased copper usage collectively fueled a robust underlying demand for the metal. Simultaneously, mining production faced a confluence of constraints: stringent environmental regulations, persistent labor disputes, and the inherently protracted timelines required to develop new extraction sites. These fundamental supply and demand imbalances, a natural confluence of forces, inadvertently created prime opportunities for market manipulation, opportunities that a trader of Hamanaka's unparalleled skill and cunning could exploit for truly enormous profits. Yet, Hamanaka's ambitions transcended the mere pursuit of simple profit maximization. Industry observers would later come to realize that he had developed an almost pathological obsession with the very act of controlling copper markets. He viewed price manipulation not merely as a shrewd trading strategy, but as an ultimate intellectual challenge, a profound demonstration of his supposedly superior market understanding. This deep-seated psychological motivation, an insatiable need for validation, would relentlessly drive him to embrace increasingly dramatic and reckless risks as his hidden empire inexorably expanded throughout the 1990s. What remained utterly inconceivable to anyone at Sumitomo, the venerable London Metal Exchange, or any of the myriad regulatory authorities worldwide, was the terrifying truth. Their trusted copper trader had systematically begun to amass positions of such gargantuan scale that he possessed the power to single-handedly influence global commodity prices. By 1991, Hamanaka was no longer simply trading copper. He was transforming into copper's secret master, an unseen puppeteer pulling the strings that dictated prices for a metal utterly essential to the very fabric of modern civilization. Let us rewind, then, to trace the origins of his audacious ascent, to the pivotal moment when a quiet Japanese trader first truly grasped the terrifying realization that he could move markets upon which entire nations depended. The copper trading floor at Sumitomo Corporation's downtown Tokyo headquarters hummed with a palpable, yet controlled, intensity. This was the arena where Yasuo Hamanaka arrived punctually each morning at 6:30 a.m., an early start that allowed him invaluable time to meticulously review overnight developments from the London markets, scrutinize the latest production reports streaming in from mining operations across the globe, and meticulously prepare for the day's trading session, which would formally commence with the opening of London markets at 2:30 p.m. Tokyo time. By 1985, Hamanaka had unequivocally established himself as one of Sumitomo's most promising and respected commodities traders. However, the true catalyst for his audacious manipulation was not a grand vision for market domination, but a desperate attempt to conceal a massive financial failure. In 1985, Hamanaka and his superior at the time, Saburo Shimizu, incurred significant losses from their physical copper trading in the Philippines. In a misguided attempt to recoup these losses, the duo began engaging in unauthorized speculation using copper forward contracts on the London Metal Exchange, LME. Instead of recovering the funds, their speculative positions worsened, and the deficit quickly ballooned to approximately $60 million. Faced with the prospect of corporate disgrace, they chose to bypass internal controls entirely, entering into off-the-books deals to hide the mounting debt. When the situation became untenable, Shimizu quietly resigned from his post, leaving Hamanaka to take over as the head copper trader. Believing he could eventually trade his way out of the massive hole, Hamanaka established a secret set of unauthorized trading books, a deceptive practice that would serve as the actual foundation for his decade-long manipulation of the global copper market. This initial deception highlights a classic case of the sunk cost fallacy mixed with the high-pressure culture of saving face in Japanese corporations. For Hamanaka, the unauthorized trading wasn't born out of pure greed, but from a desperate, escalating need to erase a past mistake. Each subsequent loss didn't signal a need to stop. Instead, it acted as a psychological trap, convincing him that a larger, even riskier gamble was the only way to restore his honor and the company's books. The copper markets in the mid-1980s largely operated according to time-honored patterns that had remained remarkably consistent for decades. Mining companies extracted the raw ore, refined it into pure metal, and then sold it to manufacturers who eagerly incorporated copper into construction projects, sophisticated electronics, and a myriad of industrial applications. Traders like Hamanaka served as the crucial intermediaries in this chain, strategically buying metal when supplies were abundant and selling judiciously when demand inevitably surged. Profits, in this traditional model, were derived from the difficult but straightforward art of accurately anticipating price movements, guided by fundamental principles of supply and demand. It was a challenging business, certainly, but one that richly rewarded deep market knowledge and meticulous, sober analysis. The intricate technical structure of copper trading presented additional, subtle opportunities for manipulation, which Hamanaka studied with painstaking diligence. The London Metal Exchange, for instance, operated through a system of daily price-setting sessions, a boisterous spectacle where traders congregated in a ring and literally shouted their orders, establishing official prices that subsequently influenced transactions across the globe. Crucially, however, the LME also permitted the extensive use of derivative contracts, options, futures, and swaps, financial instruments whose value was derived from underlying copper prices, but which did not necessitate immediate physical delivery of the metal. For Hamanaka, these were not just abstract contracts. They were the invisible bricks with which he would build his fortress. These financial instruments, Hamanaka realized, opened unprecedented avenues for building vast, influential positions without immediately impacting physical copper supplies, thus providing a cloak of invisibility. Hamanaka's first major transformative insight revolved around the often overlooked symbiotic relationship between the financial and physical copper markets. While derivative contracts undeniably offered traders the alluring opportunity to speculate on price movements without ever having to handle actual metal, these contracts were ultimately and intrinsically connected to physical copper through complex delivery mechanisms and the immutable forces of arbitrage. A trader who possessed the foresight and means to accumulate substantial positions in both financial instruments and physical copper could, with calculated precision, create artificial supply conditions that would ripple through and influence prices across the entire market structure. The very storage and logistics inherent in copper trading provided yet another powerful leverage point, one that Hamanaka began to exploit with methodical ruthlessness. Unlike ephemeral currencies or abstract bonds, which existed primarily as electronic records, copper trading inherently involved a physical metal that had to be tangible, stored, transported, and eventually delivered. The London Metal Exchange maintained a global network of approved warehouses where copper could be securely stored and then traded. But warehouse capacity, Hamanaka keenly observed, was finite, and storage costs were far from negligible. A trader who could gain dominant control over substantial warehouse stocks could, in effect, create an artificial scarcity in the physical market, a scarcity that would inevitably drive up prices for everyone else. His method involved accumulating copper positions through a multitude of discrete accounts and various trading vehicles, carefully spreading his exposure across different contracts and delivery periods. This elaborate compartmentalization was designed precisely to avoid detection. When his aggregated positions became sufficiently large to subtly influence prices, he would then meticulously manage the timing and execution of his trades to maximize their impact on market movements. A true maestro of market timing. The initial results of these clandestine experiments exceeded Hamanaka's most optimistic projections. Copper prices, which had hitherto been trading within relatively stable and predictable ranges, began to exhibit an increased volatility that correlated uncannily with his trading activities. More disturbingly, other market participants, unaware of the puppet master, began to unconsciously adjust their behavior in response to price signals that Hamanaka was artificially creating. Mining companies, for instance, modified their production schedules based on price forecasts that, unbeknownst to them, reflected Hamanaka's manipulation rather than genuine organic supply and demand conditions. Sumitomo's management initially viewed Hamanaka's burgeoning trading success as undeniable evidence of his exceptional market insight, rather than any hint of illicit manipulation. His burgeoning profits throughout 1986 and 1987 contributed significantly to the corporation's overall earnings, earning him widespread recognition as one of Japan's most skilled and prescient commodities traders. The company, in turn, granted him increased autonomy and progressively larger trading limits, unknowingly bestowing upon him the very resources that would fuel his empire building throughout the subsequent decade. This period reveals a fatal flaw in corporate governance, known as key man risk. Sumitomo had allowed its entire copper destiny to rest upon the shoulders of one man, creating a dangerous positive feedback loop. As long as Hamanaka delivered record profits, the senior management engaged in willful blindness, choosing not to audit the genius who was making them rich. And it serves as a stark lesson for the business world. A profit that cannot be explained by market logic is not a victory. It is a ticking time bomb of unmanaged risk. Yet, Hamanaka's escalating success carried with it a dangerous psychological toll. The industry's growing recognition of him as a master trader fed a burgeoning ego that began to perceive market manipulation not just as a remarkably effective profit strategy, but as a profound intellectual validation of his supposedly superior understanding. He started, in his private thoughts, to refer to himself as Mr. Copper, seeing his ability to move colossal markets as the ultimate confirmation of his exceptional, almost godlike, capabilities. The accelerating international expansion of Sumitomo's trading operations during the late 1980s serendipitously provided Hamanaka with additional, invaluable tools for the construction of his hidden empire. The company established new trading offices in key financial hubs like London, New York, and Singapore, thereby forging a truly global network that facilitated round-the-clock trading activities. Hamanaka expertly leveraged these international offices to execute trades across multiple jurisdictions, a deliberate strategy designed to make it exceedingly difficult for any single regulatory authority to gain a comprehensive, holistic view of his complete trading activities. His cultivated relationships within Sumitomo also proved instrumental in facilitating his elaborate manipulation schemes. Hamanaka's quiet and almost unassuming personality, combined with his undeniable technical expertise, made him appear inherently trustworthy and supremely competent to his supervisors, who increasingly came to rely heavily on his market assessments for their own trading decisions. He painstakingly cultivated relationships with junior traders and administrative staff, subtly grooming them to help execute his intricate strategies without ever fully grasping their true scope or nefarious purpose. By 1988, Hamanaka had meticulously established the fundamental framework for what would soon become the largest and most audacious commodity manipulation scheme in history. His trading positions, while already substantial by any conventional standard, represented merely the nascent beginnings of an empire that would eventually encompass an astonishing 5% of the entire global copper supply. The cascading profits flowing from his early manipulation experiments provided both the crucial capital and the surging confidence necessary for expanding his operations to scales that would ultimately threaten the very stability of international copper markets. The regulatory environment of the late 1980s, remarkably, proved to be extraordinarily conducive to Hamanaka's clandestine activities. Oversight of international commodities trading remained frustratingly fragmented, parceled out among a multitude of agencies operating in different countries. This created gaping seams and jurisdictional overlaps that sophisticated manipulators like Hamanaka could expertly exploit. The London Metal Exchange, while diligently maintaining extensive trading records, regrettably lacked the advanced analytical tools necessary to detect intricate manipulation schemes that deliberately operated across multiple contracts and various time periods. As 1989 dawned, Hamanaka stood at a crucial crossroads, facing a momentous decision regarding the ultimate scope of his ambitions. His manipulation experiments had unequivocally demonstrated that copper markets could indeed be controlled by a sufficiently determined and well-capitalized trader. The profound question that now lingered was how far he was truly willing to push his illicit advantages, and whether his hidden empire could continue its relentless expansion without eventually attracting the very attention that would inevitably bring his meticulously crafted schemes to a grinding halt. Throughout the pivotal years of 1989 and 1990, Yasuo Hamanaka methodically orchestrated a profound transformation of his trading operations. What had begun as sophisticated market positioning slowly, imperceptibly, evolved into a systematic and all-encompassing market control. The empire he so painstakingly constructed operated through intricate layers of complexity, each designed with meticulous precision to obscure its true scope from the watchful eyes of regulators, the competitive scrutiny of rivals, and even the closest colleagues within his own Sumitomo Corporation. Each component of his vast manipulation network, when viewed in isolation, appeared entirely legitimate. Yet, when pieced together, they formed a cohesive system capable of dictating copper prices across multiple global markets simultaneously. The very bedrock of Hamanaka's burgeoning empire lay in his unparalleled mastery of the London Metal Exchange's intricate trading mechanisms. Unlike conventional stock markets, where individual transactions are immediately transparent and visible to all participants, the LME functioned through a fascinating blend of boisterous open outcry trading, discreet telephone negotiations, and veiled private deals. This inherent opacity provided myriad opportunities for Hamanaka to cunningly conceal his truly colossal positions. He ingeniously exploited these opaque features by deliberately spreading his copper purchases across dozens of disparate accounts, numerous trading entities, and a dizzying array of contract periods. His core strategy involved meticulously building what traders term net long positions, that is, owning significantly more copper through various financial instruments than he had committed to sell forward for future delivery. However, instead of accumulating these positions through obvious, massive purchases that would instantly send prices soaring and raise red flags, Hamanaka employed sophisticated timing and elaborate disguise techniques. He would acquire copper contracts gradually, patiently, over weeks or even months, skillfully interleaving his clandestine purchases with normal, legitimate trading activities. This artful camouflage prevented the creation of conspicuous price spikes that might otherwise attract unwanted attention from astute market watchers. The physical storage aspect of Hamanaka's empire provided crucial, tangible leverage for his manipulation schemes. Copper trading, uniquely, it involved not just abstract financial contracts, but actual, physical metal that demanded secure storage in LME-approved warehouses. By systematically accumulating vast quantities of physical copper and meticulously storing it in these designated LME-approved facilities, Hamanaka could artificially engineer a scarcity in the physical market. This manufactured shortage, in turn, exerted a profound effect on both immediate spot prices and the values of future contract agreements. Market participants desperately needing immediate copper delivery would find supplies artificially constrained, leaving them with no recourse but to pay premium prices dictated by Hamanaka's hidden hand. Hamanaka's sophisticated warehouse strategy extended across multiple strategic locations throughout Europe and Asia. This geographic dispersion was a calculated move, designed to prevent any single facility from accumulating suspicious concentrations of metal that might betray his true control. He deftly employed a web of intermediary companies and strategic trading partnerships to further obscure his ultimate command over these warehouse stocks, thereby fostering the illusion of diverse ownership, while he, in fact, maintained centralized, iron-fisted control over all critical supply decisions. At the heart of this web was a tight-knit shadow network of complicit brokers who helped execute these massive trades and obscure his true intent. A key figure was David Campbell, who began collaborating with Hamanaka in 1989. When Campbell left his firm, RST Resources, to found Global Minerals and Mining Corp in 1993, Hamanaka took his business there. He's setting up an elaborate cyclical scheme. Hamanaka would buy physical copper warrants from Global, which had sourced them from a Zambian producer, only to sell them right back to the same producer in a continuous loop. These wash trades created a false veneer of legitimate commercial activity, which Hamanaka used as justification to establish massive futures positions as supposed hedges. Another crucial node in this shadow network was Winchester Commodities Group, founded by Charles Vincent and Ashley Levitt. Winchester served as the primary broker for Hamanaka's most aggressive and complex plays, funneling unprecedented volumes of trades that lacked any genuine commercial rationale, yet generated exorbitant commissions for the complicit brokers. This deliberate geographic spread also significantly complicated regulatory oversight. as authorities in different countries often operated with frustratingly limited coordination and fragmented intelligence. The sheer financial engineering required to support Hamanaka's expanding empire demanded a truly sophisticated and nuanced understanding of derivative instruments and complex currency relationships. He ingeniously utilized copper options to dramatically amplify his market exposure, achieving significant leverage without requiring a proportionally vast capital investment up front. Intricate currency swaps and forward contracts allowed him to skillfully hedge against volatile exchange rate risks while steadily building his colossal positions. These complex financial structures, artfully dispersed across multiple international jurisdictions, rendered it extraordinarily difficult for any single oversight authority to accurately calculate his total market exposure, effectively cloaking his true influence. By 1991, keen industry analysts began to observe unsettling, unusual patterns emerging in copper markets, anomalies that nobody could adequately explain through conventional means. Prices exhibited an increased, inexplicable volatility that bore no logical correspondence to the obvious fundamentals of supply and demand. Physical copper supplies inexplicably appeared tighter than both mining production figures and industrial demand indicators suggested they should be. These perplexing anomalies generated extensive speculation within the industry about possible manipulation. However, a definitive smoking gun did actually emerge in 1991. David Threlkeld, a London-based copper broker, received a brazen fax from Hamanaka requesting him to issue backdated invoices for non-existent trades worth up to $500 million to satisfy Sumitomo's internal audits. Threlkeld flatly refused and blew the whistle, forwarding the hard evidence to the London Metal Exchange and the Securities and Investments Board, SIB. Astonishingly, the LME and SIB concluded they lacked the jurisdiction to take enforcement action because Sumitomo was not a direct member of the exchange, and merely pressured Sumitomo to release the letter publicly. This resulted in no significant disciplinary action against Hamanaka, allowing his massive market manipulation to continue unhindered. The chilling atmosphere surrounding this failure of oversight was further compounded by the tragic and mysterious death of Paul Scully, and an employee at Threlkeld's firm, DLT Incorporated. It was Scully who had initially warned Threlkeld about the glaring irregularities in Hamanaka's trading practices. In July 1991, right around the time these warnings were being escalated, Scully died in a suspicious house fire. Although two separate investigations later ruled the fire as an accident, the timing of his death cast a dark shadow over the affair and raised significant suspicions years later when the full, terrifying extent of Hamanaka's fraud was finally exposed to the public. Hamanaka's astounding success in eluding detection stemmed, in part, from his profound and meticulous understanding of regulatory limitations and the systemic gaps in oversight. International commodity markets, then as now, operated under a fragmented patchwork of supervision, with different agencies often responsible for different, isolated aspects of trading activity. The London Metal Exchange, while rigorously regulating trading conduct during official sessions, possessed surprisingly limited visibility into crucial off-exchange transactions. National securities regulators, in their turn, focused primarily on domestic markets and utterly lacked comprehensive jurisdiction over the sprawling, complex world of international commodity trading. The profits generated by Hamanaka's manipulation schemes during this period were, by any metric, utterly staggering. Conservative estimates suggest that his clandestine trading activities generated several $100 million in pure profit for Sumitomo Corporation between 1989 and 1992. Crucially, these profits flowed not merely from accurate market predictions, but directly from Hamanaka's unique, illicit ability to create the very market conditions from which he subsequently profited. He was, in an unprecedented fashion, simultaneously the cause of price movements and their primary, most significant beneficiary. While Sumitomo later claimed they were entirely oblivious, evidence suggests a terrifying level of willful blindness within the senior management. When Wall Street bankers from J.P. Morgan directly approached Sumitomo's executives in 1994 with concerns about these gargantuan transactions, the brass not only confirmed their awareness, but Akio Imamura, Hamanaka's superior, even boasted, You are not seeing the whole deal. There are a couple of legs to this. Driven by the illusion of massive profits, the leadership actively chose to look the other way. The company's internal controls, meticulously designed for conventional trading operations, were woefully inadequate for detecting sophisticated manipulation schemes that, by their very nature, operated across multiple disparate markets and a complex array of financial instruments. Hamanaka's quiet personality and undeniable technical competence made him appear utterly trustworthy to supervisors who, crucially, often lacked the granular, detailed market knowledge necessary to critically evaluate the true nature of his activities. The relentless international expansion of Hamanaka's personal empire during this period vividly reflected his surging confidence and escalating ambition. He meticulously established crucial trading relationships with major copper consumers and producers worldwide, shrewdly positioning himself as an indispensable intermediary in the vast, interconnected web of global copper markets. Mining companies, unknowingly, began consulting with him on critical matters of production planning and pricing strategies, seeking advice from the very person who was actively manipulating the markets upon which their livelihoods depended. Hamanaka had become a god in a temple of his own making, but even gods are bound by the laws of gravity. Hamanaka's manipulation techniques were not static. They evolved constantly, adapting and refining as he learned to exploit new opportunities and deftly circumvent emerging threats. He developed sophisticated, innovative methods for coordinating his activities across multiple time zones, leveraging the inherently global nature of copper trading to maintain continuous, unrelenting market pressure. His colossal trading positions would fluidly shift between London, New York, and Asian markets as daily trading sessions moved around the world, thereby establishing a persistent, inescapable influence over prices regardless of geographic location. The profound psychological impact of this sustained, illicit success began to subtly, yet dangerously, affect Hamanaka's decision-making. His extraordinary ability to move markets that entire nations depended on fed an ever-growing ego, leading him to perceive market manipulation as an ultimate intellectual achievement rather than as a profound criminal activity. He began taking larger, increasingly reckless risks and building more aggressive, dominant positions. He was utterly confident that his supposedly superior understanding of the markets would enable him to maintain absolute control indefinitely. By 1992, Hamanaka had solidified his command over copper positions valued at several $billion, spread across a dizzying array of markets and instruments. His insidious influence over copper prices had become so extensive that industry participants, in their unwitting innocence, meticulously planned their entire operations around price signals that he was artificially creating. Mining companies adjusted their vital production schedules based on demand forecasts that, tragically, reflected Hamanaka's manipulation rather than genuine, organic market conditions. The sheer, colossal scale of his hidden empire had grown beyond anything the copper industry had ever remotely experienced. Yet, as astonishingly, regulatory authorities remained entirely unaware of its very existence. Hamanaka had successfully created a sophisticated, impenetrable system for controlling a commodity essential to modern civilization, all while cunningly avoiding detection by the very oversight agencies specifically designed to prevent exactly such manipulation. His silent empire operated in a terrifying paradox, in plain sight, hidden behind impenetrable layers of complexity that rendered its true, staggering scope invisible to all outside observers. The question that now remained was whether this meticulously constructed silent empire could continue operating indefinitely, or whether the increasing scale and sheer audacity of Hamanaka's activities would eventually create irresolvable contradictions that would inevitably expose his manipulation schemes to an unforgiving regulatory scrutiny and market forces far beyond his control. By 1993, Yasuo Hamanaka had achieved something utterly unprecedented in modern commodity markets, a feat that defied the very principles of open competition and supply and demand. He had, with cunning and relentless precision, become the unseen architect, the invisible hand that single-handedly guided global copper prices. Each dawn, as traders stirred in the bustling pits of London, the frenetic floors of New York, the sleek offices of Singapore, and the disciplined exchanges of Tokyo, Their critical decisions were shaped by price signals and market conditions that Hamanaka was systematically, often subtly, twisting to his will. Mining executives, mapping out their production schedules years in advance, found themselves responding to demand forecasts that reflected Hamanaka's artificial influence, rather than genuine industrial needs or geological realities. Construction companies, grappling with tight budgets, were forced to incorporate copper costs bloated by his insidious manipulation premiums, unknowingly funding his clandestine empire. One man, sitting quietly within the vast Sumitomo Corporation, had effectively usurped the role of market dynamics, becoming the secret conductor of a global economic orchestra, pulling strings no one else could see. The mechanics of Hamanaka's pervasive price control operated through an elaborate, meticulously choreographed manipulation of both the physical and financial copper markets. During the vibrant Asian trading hours, he would initiate his daily plays through Sumitomo's Tokyo office, strategically buying or selling massive copper contracts to establish the initial price direction for the trading day. As the torch passed westward to the London markets, his seasoned traders there would diligently reinforce these signals, executing complementary transactions that amplified the carefully orchestrated price movements. By the time the New York markets roared to life, additional precisely timed trading activities would consolidate the day's nascent price trends, cementing Hamanaka's desired valuation. This relentless, round-the-clock coordination was a logistical marvel, demanding extraordinary sophistication and unerringly precise timing. Hamanaka had to master a dizzying array of variables: volatile currency fluctuations, the disorienting differences across global time zones, the intricate regulatory variations across diverse markets, and the complex interrelationships between myriad copper products and their specific delivery periods. He maintained an arsenal of detailed models, continuously tracking every conceivable data point: global copper supplies, burgeoning warehouse stocks, real-time manufacturing demand, and even subtle seasonal consumption patterns. This vast trove of intelligence was then ruthlessly optimized to refine his manipulation strategies for maximum impact and minimal detection. The physical copper markets, the very bedrock of genuine industrial commerce, provided the tangible foundation for Hamanaka's audacious price manipulation. His genius lay in his iron-fisted control of critical warehouse stocks and strategically bottlenecked delivery schedules. By accumulating gargantuan quantities of copper in key locations, ports, logistical hubs, and exchange-approved warehouses across continents, he could engineer artificial scarcity, a mirage of undersupply that forced other desperate market participants to pay exorbitant premium prices. When industrial consumers, from electronics giants to infrastructure builders, urgently needed immediate copper delivery, they found supplies mysteriously constrained, with available metal commanding prices that reflected Hamanaka's fabricated scarcity rather than actual underlying supply conditions. Hamanaka's influence extended far beyond simple price manipulation. It warped the very fabric of fundamental market relationships and distorted industrial planning on a global scale. Mining companies, which traditionally operated according to geological constraints, long-term demand forecasts, and capital expenditure cycles, found themselves reacting not to genuine market signals, but to the spectral price movements Hamanaka was artificially creating. When copper prices spiked due to his hidden hand, miners would scramble to increase production capacity, pouring capital into exploration for new deposits. Conversely, when his subtle trading activities signaled weakening demand, a phantom of his own making, mining operations would abruptly reduce output and delay crucial expansion plans, unwittingly dancing to Hamanaka's tune. The derivative instruments Hamanaka wielded to amplify his market control had, by 1993, exploded in both scale and complexity. His positions were not merely straightforward copper futures and options, but a labyrinth of sophisticated financial structures that derived their value from copper prices without requiring immediate physical delivery. These ingenious instruments allowed him to build market exposure worth billions of dollars, all while deploying only a fraction of that amount in actual capital. A definitive example of this escalating complexity was the infamous RADR transaction executed in June 1993, cleared through the brokerage Credit Lyonnais Rouse. The strategy was born out of sheer desperation after the London Metal Exchange implemented new regulations limiting backwardation to 25 pounds, a move that severely damaged Hamanaka's portfolio. In a frantic bid to recoup his losses, he constructed a convoluted 6-stage options portfolio that completely dwarfed the available market inventory. The RADR play involved a dizzying array of maneuvers, buying 1 million metric tons in call options, executing short strangles to generate $94 million in premiums, selling futures to lock in synthetic price floors, and layering multiple put options to manipulate break-even points. However, this architectural marvel of financial engineering failed spectacularly when the LME intervened a second time, tightening backwardation limits to a mere $5 and ordering Credit Lyonnais Rouse to drastically reduce its positions. This regulatory clampdown caused the RADR strategy to implode, saddling Hamanaka with a staggering realized loss of approximately $1.1 billion from this single series of trades alone. Yet, like a gambler doubling down on a losing hand, Hamanaka absorbed the billion-dollar blow in silence, pressing even harder on the scales of global industry to recover his footing. Industrial consumers, the lifeblood of the copper market, found themselves unknowingly planning their entire operations around Hamanaka's manipulations, rather than around genuine market fundamentals. Electronics manufacturers budgeted for copper costs that incorporated his artificial price premiums, unknowingly paying a tribute to his hidden empire. Construction companies adjusted their project timelines based on copper availability that reflected his stranglehold over warehouses, not actual supply conditions. Electrical utilities, planning vital infrastructure investments, relied on price forecasts that Hamanaka's trading activities had subtly, yet profoundly, distorted. The intricate web of international trade relationships, upon which copper markets fundamentally depended, was increasingly shaped by Hamanaka's insidious manipulation strategies. Countries that exported copper found their national revenues directly affected by prices that one solitary trader was artificially influencing. Nations that imported vast quantities of copper for their burgeoning industrial development faced costs that reflected his manipulation premiums rather than the competitive, transparent market pricing they expected. These pervasive distortions rippled through national economies, affecting economic planning and development strategies across multiple continents, sowing confusion and inefficiency. Hamanaka's price manipulation began to create increasingly obvious anomalies that even the most seasoned industry analysts struggled to explain through conventional economic theories. Copper prices exhibited erratic volatility patterns that simply did not correlate with any discernible supply and demand fundamentals. Physical copper supplies appeared chronically tight, almost miraculously so, despite ample mining production statistics. Frustrated market participants reported immense difficulty obtaining copper for immediate delivery, even when official inventories seemed more than adequate. According to official statistics, the venerable London Metal Exchange, as the world's primary copper trading venue, grew increasingly concerned about market conditions that defied traditional pricing models. Exchange officials initiated discreet investigations into possible manipulation. Yet, Hamanaka's sophisticated concealment methods, a masterpiece of financial obfuscation, made it excruciatingly difficult to pinpoint specific trading activities responsible for the growing anomalies. His gargantuan positions were meticulously spread across so many disparate accounts, legal entities, and financial instruments that no single investigation, however diligent, could ever hope to unravel their true, cumulative impact. Regulatory authorities in multiple countries began receiving a rising tide of complaints from industrial copper consumers, who reported inexplicable difficulty obtaining metal at reasonable, competitive prices. Government economists meticulously analyzed copper markets, desperately trying to understand why prices remained stubbornly elevated despite what appeared to be perfectly adequate supplies. Central banks, in their solemn deliberations, studied copper price trends as critical indicators of broader economic conditions, unknowingly incorporating Hamanaka's systemic manipulation into their fundamental monetary policy considerations. The profits that flowed from Hamanaka's price manipulation during 1993 and 1994 reached levels that strained credulity, even within the colossal Sumitomo Corporation itself. His trading division generated returns that not only exceeded, but often dwarfed, the profitability of major industrial operations within the conglomerate, results that, under normal circumstances, should have triggered intensive, uncompromising scrutiny. However, the sheer complexity of commodity trading, coupled with Hamanaka's deeply ingrained reputation for unparalleled expertise and his quiet, unassuming demeanor, and allowed these extraordinary profits to be conveniently attributed to exceptional skill, rather than outright market manipulation. International copper producers and consumers, bewildered by the shifting landscape, began adapting their long-term strategies to accommodate what they perceived as unsettling but unavoidable new market realities. They remained blissfully unaware that they were, in fact, merely adapting to Hamanaka's pervasive manipulation. Mining companies invested heavily in developing new, previously uneconomical extraction techniques and exploring marginal deposits, all in response to prices that reflected artificial rather than genuine demand. Manufacturing companies redesigned products, striving to reduce their copper content, unknowingly responding to the manipulation premiums that Hamanaka was systematically extracting from the global economy. The economic ripple effects of Hamanaka's price manipulation extended far beyond the immediate copper markets themselves. Entire industries that depended heavily on copper, construction, electronics, telecommunications, electrical equipment manufacturing, found their cost structures significantly distorted by prices that incorporated his unseen manipulation premiums. These insidious cost increases were inevitably passed along to end consumers, manifesting as higher prices for homes, essential appliances, and critical infrastructure projects, subtly eroding purchasing power worldwide. By 1994, Hamanaka's control over copper prices had become so extensive, so deeply ingrained, that market participants, vaguely sensing an unseen force, began colloquially referring to unusual price movements as the Tokyo effect, unknowingly attributing market manipulation to his influence without fully comprehending its actual source or the man behind it. The Tokyo effect was more than a trading anomaly. It was a hidden tax on global progress. When Hamanaka artificially inflated copper prices, the cost of building a home, manufacturing a laptop, or expanding a national power grid rose in tandem. Millions of people worldwide were unknowingly paying a Hamanaka premium on their daily essentials, proving that in a connected economy, the shadow of one man's desk in Tokyo could reach the pockets of a consumer halfway across the world. His empire had grown beyond anything previously seen or even imagined in commodity markets. Yet, its very success was inexorably creating pressures that would eventually threaten its continued, precarious operation. The paramount question now facing Hamanaka was whether he could possibly maintain control over increasingly vast and complex positions indefinitely, or whether the sheer growing scale of his empire would ultimately create insurmountable contradictions that would inevitably expose his manipulation to regulatory detection and unforgiving market forces that transcended even his sophisticated control systems. The sheer scope of Yasuo Hamanaka's financial empire by 1994 utterly defied conventional understanding of individual trading capacity and market influence. Conservative estimates suggested that his intricate web of copper positions across all markets and instruments totaled an astonishing approximate $8 billion in notional value, a sum roughly equivalent to half of all copper produced worldwide in an entire year. These gargantuan positions were not consolidated, but painstakingly distributed across hundreds of different accounts, shell trading entities, and complex financial instruments, creating a hydra-headed web of exposures so opaque and labyrinthine that even the most sophisticated forensic auditors would have struggled intensely to trace its complete scope and true magnitude. Hamanaka's clandestine trading activities generated cash flows that rivaled those of major multinational corporations, yet they operated through mechanisms meticulously designed to obscure both their source and their staggering magnitude. His profits during peak years soared past $500 million annually, money that flowed into Sumitomo Corporation's accounts, cunningly disguised as routine, high-volume commodity trading returns. These extraordinary profits, almost gravitational in their scale, should have triggered immediate and intensive scrutiny. But again, the inherent complexity of international copper markets and Hamanaka's long-established reputation for unparalleled expertise allowed them to be conveniently, if naively, attributed to exceptional trading skill rather than calculated market manipulation. The colossal capital requirements for maintaining Hamanaka's sprawling empire necessitated a level of sophisticated financial engineering that ruthlessly exploited gaping holes in international banking regulations and antiquated commodity financing rules. Rather than a self-sustaining profit machine, Hamanaka's empire was actually a desperate, debt-fueled house of cards. By 1993, having exhausted his credit lines with LME brokers, he turned to Wall Street. To hide his mounting losses and maintain his massive squeeze, he borrowed staggering sums, including $400 million from J.P. Morgan, $500 million from Chase Manhattan, and another $500 million from Merrill Lynch, funding his market control through sheer, unsustainable borrowing. Unsuspecting banks that provided this massive financing viewed copper as a stable, highly liquid commodity, perfectly suitable for collateral purposes, never realizing they were unwittingly funding a systematic, deliberate market manipulation on an unprecedented global scale. The very titans of finance, who prided themselves on risk assessment, had become the unwitting architects of their own impending crisis. Hamanaka's warehouse operations had evolved into a globally distributed network of storage facilities, strategically located to control substantial portions of immediately available copper supplies. His various companies and trading partnerships maintained vast copper stocks in key locations like London, Rotterdam, Singapore, and other major trading hubs, effectively creating artificial choke points that could constrain supply whenever he needed to manipulate prices. These aggregated warehouse stocks represented billions of dollars in physical copper, metal that other legitimate market participants desperately needed but simply couldn't access at reasonable prices, held hostage by Hamanaka's unseen hand. The derivative instruments that amplified Hamanaka's market control had expanded to encompass virtually every type of financial contract related to copper pricing. He maintained complex positions in copper futures, options, swaps, and even exotic derivatives that derive their value from copper prices through intricate mathematical relationships. These instruments allowed him to command market exposure worth vastly more than his actual capital investment, creating extreme leverage that magnified both his astronomical profits and, crucially, his potential losses. International copper mining companies found themselves unknowingly operating according to production schedules and investment plans that reflected Hamanaka's manipulation, rather than genuine market conditions. When his trading activities hinted at strong demand, miners would dutifully increase production capacity and explore new deposits. Conversely, when his hidden positions required lower prices, a corresponding reduction in mining activity would follow, as companies responded to artificially weakened demand signals trapped in his web. The labyrinthine currency hedging requirements for Hamanaka's global operations created additional layers of complexity, further obscuring the empire's true gargantuan scope. Copper traded in multiple currencies across different markets, is necessitating extensive foreign exchange transactions to manage currency exposure. These hedging activities, far from being mere risk mitigation, generated their own substantial profit opportunities while providing yet another opaque veil of concealment for the underlying copper manipulation. Hamanaka's influence over copper markets had become so pervasive, so deeply entrenched, that major industrial consumers began actively consulting with him about long-term supply planning and future pricing strategies. Electronics manufacturers, construction companies, and electrical equipment producers sought his sagacious advice about market conditions and future price trends, unknowingly asking for guidance from the very person who was systematically manipulating the markets they depended on for their survival. The accounting methods that Hamanaka used to disguise his positions ruthlessly exploited the inherent differences between various national regulatory frameworks and reporting requirements. Positions held through London entities operated under British regulations, while activities in New York fell under American oversight, and his Asian operations followed entirely different rules. This regulatory fragmentation, a mosaic of oversight rather than a unified wall, made it extremely difficult for any single authority to comprehend the full, terrifying scope of his activities. Sumitomo Corporation's internal financial controls, originally designed for conventional, straightforward trading operations, proved catastrophically inadequate for detecting manipulation on the scale that Hamanaka was operating. The company's antiquated risk management systems myopically focused on individual trade sizes and daily position limits, fatally missing the cumulative impact of thousands of smaller, seemingly innocuous transactions spread across multiple markets and extended time periods. Moreover, Hamanaka's quiet personality, combined with his undeniable technical competence, made him appear inherently trustworthy to supervisors who tragically lacked the detailed knowledge and critical insight necessary to evaluate his activities rigorously. The international banking relationships that surreptitiously supported Hamanaka's empire extended across major financial institutions in multiple countries, each providing isolated pieces of financing without ever understanding their unwitting role in a much larger, insidious manipulation scheme. As credit facilities arranged through London banks supported his vast warehouse operations in Europe, Asian banking relationships funded his trading activities in Singapore and Tokyo. American banks provided crucial financing for his New York-based operations. This strategic geographic distribution deliberately prevented any single institution from recognizing the manipulation's full, interconnected scope. By 1995, Hamanaka's gargantuan trading positions required constant, meticulous attention and increasingly sophisticated management to prevent their discovery by a growing chorus of suspicious market observers. The London Metal Exchange had, by then, launched more intensive, focused investigations into the persistent market anomalies. Meanwhile, regulatory authorities in multiple countries were receiving a surge of complaints about copper market conditions that fundamentally failed to align with basic supply and demand factors. The astronomical profits generated by Hamanaka's manipulation during this period, however, created internal pressures within Sumitomo Corporation that would ultimately contribute to his exposure. His trading division's returns had become so disproportionately large relative to the company's other operations that they inevitably attracted the scrutinizing attention of auditors and senior executives, who began asking detailed, uncomfortable questions about the sources of such extraordinary, almost unbelievable profitability. The technical infrastructure required to manage Hamanaka's sprawling empire had evolved into an incredibly sophisticated information system. This digital behemoth meticulously tracked copper supplies, demand patterns, warehouse stocks, shipping schedules, and elusive market sentiment across multiple continents, offering a real-time, panoramic view of the global copper landscape. This system provided him with market intelligence that far exceeded anything any other individual trader possessed. Yet, ironically, it also created detailed records and extensive communications trails that could, potentially, expose his manipulation schemes to a forensic investigation, a digital Achilles heel. International copper consumers and producers had, unknowingly, structured their entire industries around the artificial price and supply conditions that Hamanaka was ceaselessly creating. Mining operations planned their long-term development based on demand forecasts that were fundamentally corrupted by his manipulation effects. Manufacturing companies designed new products and planned ambitious expansions based on copper prices that reflected his artificial premiums, not genuine competitive market forces. The looming question that remained was whether Hamanaka could continue managing positions of this enormous, unwieldy scale indefinitely, or whether the very success of his manipulation would eventually create insurmountable pressures that overwhelmed even his sophisticated control systems and exposed his meticulously built empire to the relentless scrutiny that would inevitably bring it crashing down. The first discernible cracks in Yasuo Hamanaka's monolithic empire became ominously visible in early 1995 when copper prices began experiencing a level of volatility that utterly exceeded even his sophisticated control mechanisms. Global economic conditions were shifting dramatically, creating fundamental, unstoppable pressures on copper markets. Asian economic growth, once a roaring engine, was perceptibly slowing, significantly reducing industrial demand for the metal, while new, large-scale mining operations in Chile and Indonesia were simultaneously increasing global supply. These genuine, unmanipulated market forces began a relentless tectonic clash with Hamanaka's artificial price support, creating escalating tensions that would eventually overwhelm his ability to maintain his precarious control. Hamanaka's response to these emerging fundamental pressures revealed both his unwavering determination and his growing, desperate recklessness. Rather than prudently reducing his positions to accommodate the undeniable changes in market conditions, he defiantly doubled down on his manipulation strategies, dramatically increasing his copper holdings and aggressively expanding his warehouse operations. While the moniker Mr. 5% reflected his share of the global physical market, his true weapon of mass financial destruction was far more concentrated. By November 1995, Hamanaka had cornered an astonishing 93% of all LME copper warrants. He wasn't just influencing the global supply, he had placed a chokehold on the actual paper claims needed by short sellers to exit their positions, giving him unprecedented and absolute dominance over the exchange. The London Metal Exchange, increasingly alarmed, began receiving more frequent and insistent complaints from industrial copper consumers who reported inexplicable difficulty obtaining metal for immediate delivery, despite seemingly adequate global supplies. Mining companies, bewildered, expressed growing concern about price volatility that bore no correspondence to obvious supply and demand fundamentals. These escalating complaints triggered more intensive, targeted investigations by exchange officials who were, at last, beginning to suspect systematic manipulation, though they still couldn't precisely identify its source or its full, terrifying scope. Hamanaka's trading activities during this period required increasingly sophisticated and elaborate concealment methods. As regulatory scrutiny inevitably intensified, he developed new, more intricate techniques for spreading positions across multiple jurisdictions and trading entities, utilizing complex financial structures that made his market control virtually impossible to trace through conventional oversight methods. These increasingly defensive measures consumed colossal amounts of time and resources, while simultaneously generating additional, unmanageable operational risks. The profits that Hamanaka's empire generated during 1995 reached levels that strained credibility even by the extraordinary standards he had established during previous years. His trading division reported returns exceeding $1 billion, numbers that represented a substantial portion of Sumitomo Corporation's total profitability. These results should have triggered immediate and intensive scrutiny from auditors and senior management. But the sheer complexity of commodity trading and Hamanaka's deeply entrenched reputation for expertise continued, miraculously, to provide cover for his increasingly audacious manipulation schemes. International copper markets began showing unmistakable signs of serious structural stress as Hamanaka's artificial price support clashed violently with weakening industrial demand. Physical copper supplies remained artificially tight due to his iron-fisted warehouse control. Yet underlying consumption was clearly declining as Asian economies slowed and European growth stagnated. This profound contradiction between artificial supply constraints and genuine demand weakness created market conditions that industry participants found increasingly difficult to understand or, more importantly, to predict. The currency crisis that dramatically affected Asian economies during 1995 created additional, unforeseen pressures on Hamanaka's empire by severely disrupting the delicate exchange rate relationships that his hedging strategies depended on. Sudden, violent fluctuations in the Japanese yen, the Thai baht, and the Indonesian rupiah catastrophically affected the dollar-denominated copper positions that formed the very foundation of his manipulation schemes. These unprecedented currency movements generated massive additional risks that profoundly complicated his already precarious position management, as threatening to unravel his entire strategy. Hamanaka's desperate attempts to maintain control over copper prices in the face of weakening market fundamentals required increasingly aggressive, almost reckless, trading tactics that left glaring, obvious traces in market data. His colossal purchases of copper contracts during periods when industrial demand was clearly, visibly declining created price patterns that sophisticated market observers, at long last, began recognizing as compelling evidence of manipulation. The unusual timing and scale of these transactions strongly suggested coordinated efforts to artificially support prices rather than genuine responses to legitimate supply and demand conditions. However, the fatal flaw that finally exposed his invisible empire, his ultimate Achilles' heel, occurred not in London or Tokyo, but on American soil. In 1994, the LME opened a new approved warehouse in Long Beach, California, effectively extending Hamanaka's tentacles into the United States. As his aggressive manipulations drove LME copper contracts to a massive premium over US-based COMEX contracts, a bizarre market anomaly emerged. Physical copper began draining rapidly out of COMEX facilities and flowing directly into the new LME Long Beach warehouse. Regulators watched in bewilderment as COMEX stocks plunged, while LME stocks inexplicably continued to surge despite a discount on forward selling prices. This highly irregular warehouse behavior right in their own backyard finally provoked the U.S. Commodity Futures Trading Commission, CFTC, to enter the fray, launching an aggressive investigation that would mark the beginning of the end for Mr. Copper. The silent walls of Sumitomo could no longer contain the thunder of an international crackdown, and the man who once controlled the world's copper was about to find himself trapped in a copper-tight cage of his own making. The international banking relationships that supported Hamanaka's operations began showing clear signs of strain as credit officers grew deeply concerned about the alarming concentration of lending exposure to copper-related activities. Banks that had provided billions of dollars in financing for his vast warehouse operations and trading activities started asking more detailed, pointed questions about the business rationale for such gargantuan positions. These uncomfortable inquiries forced Hamanaka to develop increasingly elaborate, often preposterous, explanations for his trading strategies and his insatiable financing requirements. Sumitomo Corporation's senior management finally began asking serious, penetrating questions about the true source of their copper division's extraordinary profitability during late 1995. Internal audits, once superficial, now revealed trading activities on a scale that utterly exceeded anything in the company's previous experience, with positions spread across so many different markets and instruments that their cumulative risk was almost impossible to calculate. These shocking discoveries triggered emergency management meetings and urgent demands for detailed explanations that Hamanaka, for the first time, struggled to provide convincingly. The technical infrastructure that Hamanaka used to manage his empire began experiencing catastrophic operational problems as the sheer scale and complexity of his positions finally exceeded the capacity of existing systems. Computer networks designed for conventional trading operations struggled to process the overwhelming volume of transactions required to maintain his manipulation schemes. Communication systems that coordinated activities across multiple time zones became increasingly unreliable, even breaking down, as operational demands intensified, adding further chaos to his already strained operations. International regulatory authorities, once fragmented and uncoordinated, began coordinating their investigations into copper market anomalies more effectively during 1995, sharing crucial information that revealed patterns of suspicious activity across multiple jurisdictions. The London Metal Exchange, American commodity regulators, and Japanese financial authorities started comparing their investigation results, gradually developing a more complete, horrifying picture of the manipulation that individual agencies, working in isolation, couldn't detect independently. When the full extent of the manipulation was finally revealed to the public, the world was shocked not just by the astronomical numbers, but by the man behind them. Unlike the flashy, notoriously extravagant white-collar criminals of Wall Street, Hamanaka was the absolute epitome of a relatively unspectacular Japanese salaryman, known only for his plain gray suits and steel-rimmed glasses. This incredibly unassuming, deceptive appearance had been his greatest camouflage. The sheer scale of his betrayal, perpetrated by such an ordinary-looking corporate soldier, sent profound shockwaves through the highest levels of the state. The national disillusionment was so severe that Seiroku Kajiyama, Japan's chief cabinet secretary at the time, publicly lamented the scandal with a chilling statement. The moral fiber of all Japanese has deteriorated, and they have become desensitized toward money. Yet, amidst this unprecedented financial carnage and national shame, there was one spectacular outlier. While Wall Street giants and global industrial consumers were bleeding billions, a Montreal-based scrap metal merchant named Herbie Black emerged as the sole, improbable victor. Sensing the artificial fragility of the market, Black had boldly bet his own money heavily against Hamanaka, taking massive short positions. It was a terrifying David versus Goliath gamble against the Copper King. But when the hidden empire finally collapsed and copper prices plummeted, Black's contrarian play paid off astronomically. By a narrow squeak, this scrappy merchant ended up looking like the smartest player in the room, walking away with a fortune while the rest of the financial world burned. In the devastating aftermath of the scheme's collapse, Sumitomo embarked on an aggressive legal war of attrition to recover its catastrophic losses. The corporation launched a series of massive lawsuits against the global financial institutions that facilitated Hamanaka's trades, alleging that these banks had deliberately turned a blind eye to his rogue status in exchange for enormous commission fees. This relentless legal crusade ultimately yielded staggering compensation agreements. Merrill Lynch agreed to pay $275 million in the year 2000, followed by J.P. Morgan, which settled for $125 million in 2002. UBS also paid out $86 million to resolve claims against it. But Sumitomo wasn't the only entity seeking retribution. The industrial consumers who had unknowingly paid the price for this scheme, physical copper buyers like Southwire and Asarco, also fought back. As revealed in the U.S. court case MDL Docket No. 1303, these victims launched a massive antitrust lawsuit against J.P. Morgan Chase. They alleged that the financial giant had actively aided and abetted Hamanaka, providing the critical loans and services necessary to finance and hide the artificial copper squeeze that ruthlessly inflated their manufacturing costs. The complicity of these financial giants was not merely passive. In some cases, it was deeply and actively intertwined with Hamanaka's operations. At J.P. Morgan, a key executive named Kevin Murphy cultivated a remarkably close personal relationship with the Copper King starting in 1993. This shadow alliance proved so incredibly lucrative that Sumitomo soon accounted for an astonishing 75 to 80% of the total revenue earned by J.P. Morgan's entire commodities division during that period. When Hamanaka's confession finally shattered the market illusion, the sheer panic inside J.P. Morgan was palpable. Internal documents later revealed that the bank's own audit and risk management departments were terrified that Murphy might attempt to flee the country or even commit suicide in the wake of the devastating fallout. The final domino fell in 2004 when Credit Lyonnais Rouse settled a colossal $1.1 billion lawsuit, bringing a quiet end to the legal battles stemming from the most audacious market manipulation in history. Beyond the courtroom drama, the Sumitomo Copper affair forced a fundamental metamorphosis in how global commodities exchanges are regulated, particularly at the London Metal Exchange. To ensure that no single trader could ever again corner the market and orchestrate an abusive squeeze, the LME introduced stringent new measures, most notably the lending rules. Under these new mandates, any market participant holding a dominant position, defined as owning 50% or more of the available physical warrants, is strictly compelled to lend their copper back to the market at capped, predetermined premium rates. By legally forcing dominant players to provide liquidity, this regulation effectively dismantled the very short squeeze mechanism that Hamanaka had weaponized for a decade, ensuring the ghost of Mr. Copper could never again haunt the trading rings. To complement these lending rules and eliminate the very blind spots that Hamanaka so masterfully exploited, the LME also instituted the mandatory Daily Commodity Position Report, or CPR. Under these strict new mandates, members are now required to transparently report both exchange-traded and over-the-counter, OTC, positions on a daily basis. Most importantly, this reporting must trace all the way down to the ultimate end client. This unprecedented level of daily surveillance means that no rogue trader can ever again hide massive, market-distorting positions behind a complex veil of intermediary brokers and shadow companies. But the LME didn't stop at just daily reporting. To completely seal the cracks in their infrastructure, the exchange rolled out the LME Sword system, a highly secure electronic transfer and management network for warrants. This was not merely a digital upgrade. It introduced strict new rules mandating that warrants be allocated to specific accounts on a daily basis. The sole purpose of this was to definitively identify the effective controller, the entity holding the true proprietary interest in the metal, regardless of whose hands the paper passed through. No more hiding behind shadow brokers or vague intermediary accounts. Ultimately, the intense, unrelenting pressure to implement these sweeping reforms catalyzed a profound structural evolution, the eventual demutualization of the LME itself. The ghost of Yasuo Hamanaka had forced the exchange to transform from a centuries-old, hands-off members club into a modern, strictly regulated corporate entity, forever altering the landscape of global commodities trading. Industrial copper consumers, wary of the persistent anomalies, began implementing alternative sourcing strategies to reduce their exposure to market manipulation that they couldn't identify specifically, but could clearly observe through erratic price and availability patterns. As electronics manufacturers developed new supply relationships with smaller mining operations that operated outside traditional LME channels, construction companies began cautiously substituting alternative materials wherever possible to reduce their dependence on copper that seemed perpetually subject to artificial price manipulation. The immense psychological pressure of maintaining such an enormous and precarious empire began to visibly affect Hamanaka's judgment in ways that drastically increased his operational risks. Associates described him as increasingly isolated, paranoid, and defensive, unwilling to discuss the critical details of his trading strategies even with his closest colleagues. His decision-making became more erratic, fueled by desperation, and his risk tolerance expanded far beyond any rational limits as he struggled, futilely, to maintain control over positions that had grown tragically beyond any individual's capacity to manage effectively. By December 1995, multiple converging indicators suggested that Hamanaka's empire was rapidly approaching a crisis point that would test whether even his sophisticated manipulation techniques could possibly maintain control over market forces that were increasingly, inexorably, working against his gargantuan positions. The fundamental contradiction between artificial price support and weakening underlying demand was creating pressures that would very soon exceed his capacity to manage, setting the stage for a catastrophic collapse that would send shockwaves through global commodity markets, reverberating for years to come. When the dust finally settled, the personal and corporate consequences for the Copper King were swift and severe. In 1998, a Tokyo district court sentenced Yasuo Hamanaka to 8 years in prison with hard labor. Astonishingly, Japanese prosecutors convicted him solely on charges of fraud and forgery, not market manipulation. However, international regulators did not let his corporate enabler off the hook so easily. Sumitomo Corporation was slapped with massive penalties, paying $150 million to the U.S. Commodity Futures Trading Commission and $8 million to the UK's Securities and Investments Board to settle charges of copper price manipulation. Hamanaka served his time and was quietly released in July 2005, 1 year early, for good behavior. Unlike other infamous rogue traders who capitalized on their notoriety, he retreated entirely from public life, an enigmatic figure who briefly resurfaced only to express his sheer amazement at the record-high metal prices of the modern era. However, the reckoning within Sumitomo didn't end with Hamanaka's imprisonment. Enraged by the catastrophic failure in corporate oversight, the company's own shareholders filed a lawsuit against the former directors for gross mismanagement. Ultimately, senior Sumitomo executives responsible for copper trading were forced to resign and agreed to pay $3.55 million to settle the claims, a sum that effectively wiped out half of their entire retirement benefits. Meanwhile, Saburo Shimizu, the former boss whose initial $60 million loss had sparked this entire decade-long deception, remained stubbornly silent. When called to the stand at Hamanaka's trial, Shimizu simply answered no comment to every single question asked, taking the deepest secrets of the Copper Empire's dark origins with him into obscurity. Yasuo Hamanaka's story is more than just a tale of lost billions or a failed market corner. It is a chilling reminder of the inherent fragility within our global financial systems. For 10 years, the world's most essential metal moved not by the hand of supply and demand, but by the secret whims of a single man in a gray suit. Hamanaka proved that while an individual can indeed move mountains, they can never truly conquer the market's gravity. When his silent empire fractured, it didn't just break Sumitomo. It rewrote the rules of global trade forever. Today, the ghost of Mr. Copper still haunts the trading rings of London. He's serving as a permanent warning to any who believe they are larger than the market itself. Because in the high-stakes game of global commodities, the house always wins. And the house, in the end, is the cold, unyielding reality of economic truth.